welcome to the Money Show, your daily guide to making smarter money decisions, whether it's building wealth, protecting your family, or planning your financial future. We break down the numbers so you don't have to worry about it, from mutual funds to insurance, taxes to term plans, market moves, etc., or even your money mistakes. So we bring you expert insights simplified because your money deserves more than just hard work. It deserves strategy, clarity, and a plan that works for you. So join us every day right here at the Money Show, where we believe making money is an art, but managing it, that's pure science. I'm Kavita Thapliyal, and today on the show we have a power pack lineup. But before I get into it, let me just flash our WhatsApp number and email ID, because we do answer your portfolio queries on the show live as well. So just in case you want to send across your questions, you can WhatsApp us your queries on 865-797-4571. And we have an email ID, which is themoneyshow@etnow.tv. All right, so that's the WhatsApp number and email ID where you can send across your question. Okay, so let's begin. And looking at the Indian markets, holding up global cues that remain mixed, the big question for every investor is what next? Should you stay the course, or shift gears, or relook your portfolio entirely? To help us decode the current market mood and chalk out clear, actionable investment strategies, today I'm joined by someone who brings both sharp insights and years of on-ground experience. Inderbir Singh Jolly, CEO PL Wealth Management. Under his leadership, PL Wealth has become synonymous with the structured wealth creation and goal-based investing, from navigating volatility to spotting long-term opportunities. And Mr. Jolly has guided countless investors through changing market cycles with clarity and conviction. Welcome to the show. And today we'll be taking your help in making sense out of all the market movements for our viewers. So good evening and welcome to the Money Show.
Hi, good evening, Kavita. Thank you so much for having me.
Lovely. So let's begin. And the first question is obviously going to be about market sentiment check. I really want to understand, how are you reading the current market momentum? Because with the tariff threat, sort of easing off, global uncertainty stabilizing, do you believe India is effectively capitalizing on this 90-day geopolitical window? How do you look at it?
Yeah, that's the question which is there, in every mind nowadays as we talk to clients. And so there are 4 or 5 important points to look at here. So the imposition of 26% of US reciprocal tariffs on Indian export, puts a direct pressure on, companies which have exports as a main top line income. Then adding to the pain, FY 26-27 NPS estimates have been cut by 1% and 0.9% respectively, which has basically compounded the volatility in the market. Furthermore, global downgrades, weakening dollar have all added to the overall scenario. However, to this, Indian policy has been far more accommodative. India has already, cut the repo rate by 0.5%. The government's 1 trillion, tax package and sustained, thrust on capex have provided a counter-cyclical buffer to us. We believe that domestic-oriented sectors, will outperform in the near term, because obviously we are a very strong consumption-based economy too, and we expect sectors like hospitals, domestic pharma, retail, stables, banks, defense, capital goods will continue to do good, in the shorter and in the longer term as well. So I think as a economy, Indian economies over a period of next 3 to 5 years is much better placed.
I think you've already answered my second question, but I still will ask you, because, our viewers, they not only invest for long term, but also look at short-term gains now. From a longer-term lens, India seems well positioned, definitely engaging with the current scenario, if we, in mind, engaging not just with the US, but also diversifying ties with Europe and other major economies in the region. But in the short term, with the rising trade deficit, now specific triggers I'm pointing out so that you can elaborate more on it. In the short-term deficit, trade deficit weakening, rupee, and muted earnings, would you say the risk currently outweighs the rewards? How do you look at it?
So if you see, the broad points here is that today we have a 1-year forward P of say 17.2x on the Nifty side. This is about 9% lesser than the last 15-year average, about 18.9. So as an index, we are reaching at decent valuations. Uh, we believe that, and we have portrayed that in our India strategy report as well, that considering the PE ratios and considering the NPS earnings, the difference between a bull and a bear estimate is not very high. So today we are at, if we continue at the same rate, we are looking at a Nifty at 25,500. If you look at a bear rate, it may be 24,800. If you look at a bull rate where we recover back to the last 15-year average of 18.9 P, we will be at 27 and a half. So to be very honest, a short-term volatility and risks remain, but if we do right asset allocation, if we are into the right, large cap and flexi cap categories, and we invest, in selected sectors where we have domestic consumption and lesser, pertinence towards the global risks, I think there can be definitely an opportunity there. Second aspect is gold. There are asset classes which give us, tactical allocations also. Gold looks like a good tactical allocation in the shorter term. So I think it's important that if we do the right prudent asset allocation between, the right, sectors and using such kind of tactical calls, I think there is definitely some investment opportunity in the short term. But yes, uh, if you want somebody to invest for a 3 to 5 years, I think it's a good time.
Understand the market cap and sector allocation call that you might be recommending to your clients. What about the valuation across large, mid, and small cap? If you could also, talk about this sector wise. Are you overweight on something, and what exactly in this current stage of market cycle you are recommending to your clients?
Yeah, so we feel that sectors which are, based on domestic consumption and where the demand is sustainable within our economy, like healthcare hospitals, they benefit for rising demand. They benefit from improved infrastructure. So stocks like Max Healthcare, Apollo Hospitals, Cipla are some of the top picks we have given. It's very beautifully covered in our India strategy report as well. Then telecom is another sector we feel, because there is obviously a huge surge in the data consumption. Stocks like Bharti Airtel, they also gain from, sustained capex and tariff hikes. Then consumer staples, consumer staples have always seen as a, defensive play, in volatile times. ITC, Britannia, they are all consistent players. They are good, opportunities now also. Some of the other sectors where we feel that we can be aggressive or bullish is travel aviation, because there is obviously recovery in travel. And of course, festivals, lower ATF prices always benefit this sector. EMS and durables, strong momentum in manufacturing exports. Then defense and capital goods, backed by government capex and PLI schemes. However, caution on peak margins, is always to be seen. But these are the sectors which we are overweight on. Mixed outlook. We have a mixed outlook on auto because we have downgraded to neutral from neutral to weak demand in PV and CV segments. Cement and metals, we expect margin recovery, price hikes in export. Still, we feel it is volatile. We are cautious or underweight in sectors, obviously IT, because of the impact of the tariffs and obviously slowing global orders. Oil and gas, because of uncertainty in the crude prices, slow growth in the energy space. Banks, while we are overweight on some of the banks in our model portfolio, like ICICI and Kotak, but overall we feel there can be some stress on the NIM or NIMs, and obviously the slowing credit growth. So this is how broadly, our sector allocations are portrayed at this stage.
I just want to know your view in terms of banking. Are you tilting more towards private banking than PSU?
ICICI and Kotak Mahindra, we have increased the allocation in our portfolio. Of course, we feel that, out of that entire, bank space, ICICI Kotak look very good at this stage. Maybe I would not want to, go deep into the PSU versus private bank, but yes, we feel looking at the credentials, ICICI and Kotak look like a good bet at this stage.
Specific pockets in healthcare, would you not be interested in that?
No, I think healthcare as an overall area, as an overall sector looks good, as long as it's domestically, so the domestic demand is good, and it caters to the domestic requirement. We feel that overall as a sector it is good.
All right, let's because we get a lot of questions where investors want to put in money lump sum. So the basic question, the very first question usually is this the right time to put lump sum money? And if at all it is, should we be just putting in one shot or should we be staggering that amount? Now, it is a very interesting strategy that one can opt for while they want to stagger the amount, also keeping the long-term horizon in mind. Talking about staggering the money across market caps, talking about having the right kind of asset allocation, what would you recommend in terms of exposures in their financial portfolio for a lump sum investment?
Yeah, so Kavita, you took the right term, you use the right term with asset allocation. I think broadly, we always recommend that every investor should maintain a good asset allocation depending on the risk profile. But yeah, the three broad categories or asset classes which clients are usually invested in are equity, hybrid, and debt. On the equity side, as I said earlier, we want to focus on high growth sectors like healthcare, hospitality, telecom, travel, durables, consumer staples, and we want to be cautious about auto, IT, oil and gas. We remain, biased towards, large cap and flexi cap allocations at this stage in our model portfolio. And investors with an aggressive approach, like you said, can invest in mid cap and small caps in a staggered, manner, which we also recommend too. On the fixed income and credit, our view is that, inflation is well anchored about 4% and global risks are intensifying. So RBI will continue to front load rate cuts in FY26 also. So if total easing of 75 to 100 bips, projected during FY26, bringing the repo rate down to 5 to 5.25%. If inflations continue to overshoot, repo could hit 5 also. So RBI is shifting gears of, from caution to action, and aiming to cushion India's growth, while global headwinds are building. Given this backdrop, we feel on the fixed income side, medium maturity corporate bonds, 3 to 5 years, they offer a good risk to reward returns. Top rated AAA or AA plus, fixed income securities are better because obviously the risk appetite at this stage is low. Investors with higher risk appetite for 3 to 5 years or 4 to 5 years horizon can also look at performing credit, or private credit as an opportunity to get some additional alpha into their fixed income portfolio. Hybrid fund we feel make a lot of sense at this stage, because whatever equity upside needs to be captured will get captured through the equity component, and through the debt component, they will benefit from the capital gains in as the bond yields will fall. So that gives a good mix, on the asset allocation. So we feel that, if investors are sticking to the strengths of each of these asset class and have a prudent asset allocation, I think they in the next 5 to 10 years will obviously have a very robust portfolio.
Absolutely, that's the key to the right financial plan or the right financial strategy. Time to pick into your personal portfolio as well. So, can you give us a broad sense of your personal portfolio positioning right now? Are you playing this market with aggression, caution, or balance?
Yeah, so usually we look at three types of risk profiles: conservative, moderate, and aggressive. Of course, I am being in the industry, so I am very aggressive. If you're asking from my perspective, of course, my equity component at this stage is about 65 to 70%, of investment. These are again my personal comments, but yeah, the asset allocation, when we look at aggressive investors, we try to maintain about 60%, 60 to 70% into equities. There in current markets, large flexi cap should definitely be there, but maybe small additions of, mid and small caps to get into at this stage. Of course, from the sectors which we feel are robust and strong. On the fixed income side, I think good quality, FD is good quality, AAA, AA plus to the allocation percentage about 20%. And then 15% of thematic alternates, can be put. So gold ETFs remain obviously a very strong thematic option. Then, private credit is also a very strong option on the fixed income side. And then there are VC and some of these kind of private equity funds. If now again I'm talking because I understand the market. So if you look at some of these opportunities, I think this allocation can be prudent for an aggressive investor. Had it been a conservative investor, the allocation to equity would have come down to about 40%, and fixed
Right?
income would have gone up to 40% with hybrid about 20%, and
Mm-hmm.
moderate would be a little bit more on equity and lesser on the fixed. So basically, we are looking at the right asset allocation mix depending on the risk
Sure.
profile.
Sure. All right. So one last question and one non-negotiable rule. Now, what's one investment call or strategy you personally never take, no matter how tempting it looks on paper?
Yeah. So again, a personal call. So a tier two or three speculative real estate buy, maybe which is overpriced, illiquid, poor rental yield, may be avoidable. At least I would definitely avoid at this stage. On the debt alternate side, also there are unregulated high yield bonds, P2P lending, which have high credit risk, low recovery, no liquidity, maybe not regulated. I think I would want to avoid such kind of asset classes, especially in current markets, or such kind of investment opportunities.
Sure. All right, with that, it's a wrap. Thank you so much for taking out time today in the Beer for this lovely conversation and with a lot of investment strategies, takeaways for our viewers. Thank you so much.
Rita, thank you for having me. It was pleasure speaking to all. Thank you so much. Have a nice day.
Pleasure. You too. Thank you. All right, time to slip into a quick break, and post that I'll be joined by Pankaj Mitpal, who will be answering your portfolio queries. So just in case you have any question, you can send us your queries on our WhatsApp number, which is 8657974571. We also have an email ID, which is themoneyshow@etnow.tv. So your portfolio queries to be answered after this break.